So you need to be saving, and more so than saving, investing in something that's going to generate a return that exceeds inflation in order to maintain your purchasing power. And that's especially true when you are trying to achieve goals that are many years out, because just like investment returns compound and build on each other, inflation does too.
I received a question on Instagram from Jennifer, and you can find me there at AndyHillMKM, and here is her question. Thank you for the podcast and posts. I just started investing, and the market has gone down a lot. Did I get in at the wrong time? Also, should I be worried about inflation as a new investor? Sorry, this stuff is all new to me. Jennifer, thank you very much for connecting on Instagram. I appreciate that. And yes, depending on when you're listening to this episode, everybody, the stock market has been off to a slower start this year, and that can have new investors like Jennifer feeling low. And the record-breaking inflation isn't helping those feelings either. To help me answer your question today, Jennifer, I've invited Meghan Rabuse on the show today. Meghan, also known as the Family Finance Mom, is the host of the popular Finance Explained podcast. She spent nearly a decade as a financial analyst before spending the last 7 years as a stay-at-home mom to 3 little ones. Her expertise in finances and family is perfect for this question. Welcome to the show, Meghan.
Thanks so much, Andy, for having me.
Well, let's answer Jennifer's question together here, Meghan. Should she be concerned when the stock market is down like this?
So first of all, I just want to say you're absolutely not alone in asking this question, and Andy, in receiving these questions. I'm getting them a ton from my listeners and followers as well. And, I feel like whenever the market ticks down, everybody kind of starts to panic, especially new or less experienced investors. And I'd like to kind of make this analogy for people. Anytime you are interested in buying something and suddenly it goes from being full price to being on sale, you're usually excited about that, right? Like there's a pair of boots that you're admiring, and all of a sudden you get like that email that says, oh, they're now 10% off or 15% off. You're like, score. And that's like your motivation to go buy it when maybe you've been holding out before. I would say people should think about when the stock market sells off in a similar way. Instead of it kind of inciting or provoking panic, think of it as the market being on sale. In many contexts, these are all the same businesses that were available at a 5 or 10% higher price a week ago, and you can now buy it for less. Now, if you are going to be retiring tomorrow and you are more concerned about capital preservation and certainty, we can talk about that a little bit more in a second, about ways to, maybe shift the balance of your portfolio to something that is more preserving your capital. But if you are looking at saving for retirement or saving for your kids' college, and that goal is 10 years away, 20 years away, 30 years away, you should not be concerned about kind of the up and downs of the market on a day-to-day, week-to-week, month-to-month basis. And instead, you should think about it as getting that email from your favorite store saying, hey, I'm on sale today.
I like that. That is a good way to think. And you know what? Get your sales, everybody, right? So let's talk about inflation, though. That's spooky, right? Should I run and hide under my desk right now because of inflation?
Right. So, inflation, I think, has been probably the single biggest impact on family finances universally over the last year. And I think most experts will tell you, like, it's not going away anytime immediately. It will gradually decline, but we're not going to see a reversal, right? It's highly unlikely we're going to see deflation. We hopefully will see kind of a slower or reduced level of inflation that is more normal, is kind of that more like 2% level. What I would say is that higher inflation, and just inflation in general, should be something that motivates people to take risk and invest more, because that is how you are going to preserve the purchasing power of your dollar. If I take $1 and I shove it under my mattress, inflation means that today, the latest numbers on inflation as of December, the CPI was at 7%, meaning that prices in December were 7% higher for the same goods and services as they were the year before. So if you put a dollar under your mattress back in December of 2020, last month it could only buy 93 cents worth of the same goods, is kind of the way to think about it. So you need to be saving, and more so than saving, investing in something that's going to generate a return that exceeds inflation in order to maintain your purchasing power. And that's especially true when you are trying to achieve goals that are many years out, because just like investment returns compound and build on each other, inflation does too. So if you're not putting your money somewhere that's going to earn you an annual return that exceeds inflation, you're losing purchasing power on your money.
Got it. Well, let's talk about maybe the swing side of that. Is, should I have no money in my account then? Because is it just losing value? Where do we draw the line with having money in our accounts?
So I think you're kind of saying, like, should I not keep anything in my checking account? Should I not keep anything in a savings account?
Yeah, like I've seen some talk on Twitter, like maybe I should just be investing everything and just put my emergencies on credit cards. Is that a smart idea? Let's talk about that a little bit.
Yeah. So a couple things. One, I think it's always smart to have, especially like something, an emergency fund, something that is going to, the kind of rule of thumb I give people is at a minimum, something that is going to cover like the deductibles. Because if you think about that, that's like an emergency, right? Like you have a car accident, you got to meet your deductible, you need cash on hand. That is money that you need certainty around. It's money that you need in the short term. I'd say kind of anything where like funds you might need inside of kind of like a 2 to 3 year time horizon, that should be funds that you want kind of liquid and accessible. And when I say liquid, I mean like I can go to the bank and I can have that cash in my hand today within 24 hours kind of scenario. In terms of relying on credit cards as an emergency fund, that can come with some element of risk too, because if you put more on it than you're going to be able to pay off, for example, it's going to cost you significantly more. Forget inflation, forget like your investment on the stock market return. Like, many credit cards today have double-digit interest rates. And so, that's going to potentially cost you more. It depends on your level of discipline, kind of your comfort with doing that. But I would say that's kind of the way I think about it, that anything you need kind of inside of like a 2 to 3 year time horizon is important to kind of keep liquid. When people talk about like investment returns, you should always think of them in kind of a long-term context. So when people talk about the stock market returns, call it 8 to 10% annually, that is an average level of return that has been true over like the last century. That includes all the ups and downs along the way, but in any given year, it could be different. And so to realize that kind of annual average, you need a longer term time horizon.
Got it. Yeah. So I like this level we're talking about. We've got the maybe 10 to 20 to 30 years for my retirement. Then I've got my 2 to 3 years that maybe I want liquid. Is there somewhere in the middle? Let's say I want to do a home upgrade in like 10 years. What else can I use besides these aggressive stocks to maybe have some midterm goals?
Sure. So there's, even within stocks, we tend to kind of talk about, most people talk about kind of 3 buckets when it comes to investing. There's cash, there's stocks, there's bonds. Stocks are going to always be kind of higher risk. In exchange for that higher risk, you get higher return. Bonds are kind of a middle range. Bonds are essentially investing in publicly traded debt. And because of that, it has greater certainty. It has less risk. In the event of a bankruptcy, the debt or the bonds get paid off first, which is why they are less risky than, say, stocks, which are the equity of a company. And they also carry what is known as interest payments. So every year you're going to get a certain level of interest paid out on that bond. And so it will likely, depending on kind of the credit risk of the company, depending on the term on the bond, is it a 5-year bond, a 10-year bond, a 30-year bond? That's going to determine the interest that gets paid out. But it's kind of a middle ground that you can straddle if you're looking for like a mid-range goal. I would also say that stocks themselves have varying degrees of risk, right? So there are the, brand new IPO'd right out of venture capital stocks that, may have 30% growth targets and have no earnings yet and could, blow up and make you 40 times your money, or they could also not exist next year. And then there are the Coca-Colas of the world and the I'm trying to think of like some other good ones that, we're going to have like dividend yields on them that are going to pay some type of,
like a Johnson and Johnson or
yeah, exactly. And so, stocks are not all equal. They're not all similar. They don't all have the same risk profile. So there are some things you can look at, to balance that risk depending on your time horizon.
Well, let's assume Jennifer shares a birthday with us. She's right around the same age as us, and she's got 20 years to retirement. And she's like, this all sounds great. I just want to make sure I'm doing my retirement thing. What's a way that she can just keep this process simple?
Sure. So one of the things that I recommend to people if they're first starting out, if they're overwhelmed by kind of like, I don't know anything, or I am nervous about trying to do this myself because I don't feel like I fully grasp all of these nuances. A great thing that is available now for many people are target date funds and even target date index funds. So what is a target date fund? So there used to be kind of this saying called invest your age, which was like a simple rule of thumb for diversifying and balancing your portfolio. And so, in our case, being 40 years old, invest your age would say I should have 60% of my portfolio in equity and 40%, that's our age, in bonds. And so what would happen is as you approach retirement, as you want more certainty around the level of assets that you're going to have to live off of, you shift your portfolio away from riskier stocks and more towards kind of more certain and secure and income yielding bonds. So target date funds do that for you. It's a way where you could choose one investment allocation in like your 401k or your other retirement fund or IRA. You could contribute all of your money to that and it will diversify it in a stock index fund and a bond index fund. Now, I make the kind of distinction between some accounts offer straight up target date funds. Some offer target date index funds. Those are kind of ideal because they're going to have the lowest fees. And that can make a big difference in kind of your long-term investing horizon.
Got it. Yeah, that makes sense. So, okay. So Jennifer was listening. Everybody else is listening. What's one step that somebody could take following this interview if they're ready to get started with investing today, but they want to keep things simple? What's one step that they could do?
So the first thing that I always tell people when they're looking at investing is first define your goal. So, just opening a brokerage account and putting money in willy-nilly is kind of skipping ahead too far. So the very first thing you want to do is define your goal. Like what are you trying to invest for? And the reason I say that that's the most important first step is because depending on that goal, there are tax advantaged accounts and investment options that may be available to you. And as we all know, given where tax rates are, those tax advantages actually can give you a big boost kind of in the return potential of the time horizon. So that's where I would tell people to start. Like, don't just start picking stocks willy-nilly. Don't just go open a random brokerage account. Say, okay, I want to save for retirement. All right, well, what options do I have available to me? Do I have an employer-sponsored retirement account? Do I need to open an IRA? Am I investing to save for my kids' college? Well, then you could open a 529 plan that's going to be a tax advantage plan. But the place to start is kind of always with, I think with a lot of financial journeys, the place to always start is what's the why? Because then that's going to lead you to make kind of the best choice that gives you the best kind of tax advantaged return over time.
That's fantastic advice. I'm so glad that I had you on here, Meghan. Please let us know where people can connect with you, learn more from you, and where's this podcast?
Sure. So you can find me on Instagram at Family Finance Mom. That's kind of where I am most of the time. You can catch me there most days. Mondays and Wednesdays, I do live Q&A on Instagram too, so you can submit your questions and I'll take those. Once a week, I publish Finance Explained. You can find it wherever you listen to your podcasts, on Apple, on Spotify, on Google Podcasts. And there I tend to kind of highlight the top 3 financial headlines of the week. And then in addition to that, do a deep dive on a specific topic, often having experts from around the financial industry. This week's episode is going to feature a Zillow economist to talk about kind of the outlook on the 2022 housing market. So, I would kind of, to compare contrast with like what you offer, Andy, like you talk a lot about personal financial stories and people's personal financial journeys. At Family Finance Mom, I really try to build people's financial literacy and keep them aware of kind of what's going on in financial markets and financial news. And that will then enable you to make the best decisions for you and your family and kind of the financial decisions that you're making. So that's where you guys can find me.
Excellent. Yes. And everybody, I enjoy Meghan's show so much. I listen to it every week on my walks. And it's that financial literacy that I'm looking for on a weekly basis, because sometimes, whatever, I'll flip on NPR or flip up Wall Street Journal or whatever, and I just get these headlines of what's going on. Meghan dives deep into what's actually happening so we understand the detail behind those quick headlines. So, Meghan, thank you so much for being here. Everybody, check out her show. And Meghan, thanks again for being here.
Yeah, thanks so much for having me.